Welcome back to the show this morning at 6:33. It was Monday as we get things underway. So, over the weekend, I wrote an article talking a little bit about just looking at statistics of presidential election years, right? So, again, what happens during a normal presidential election year? Lots of concerns this year that, obviously we're going to have a big upset in the election, one way or the other. Either, Biden's going to win or there's going to be a hung up election and concerns about nobody vacating office, whatever it is. I mean, there's just lots of, headlines going back and forth. Most of it's complete nonsense, but, it is what it is. And this, this stuff's great for media headlines, gets attention, gets views, those type of things. But when it comes to money, right, we want to know exactly, really, what do statistics say about investing during presidential election years and what happens the year after, the presidential election, right? So, a couple of important issues that, are, kind of surround where the market is currently. And again, this is, not surprising. I mean, lots of stuff going on this year. We've had the pandemic, we got coronavirus still going on. That's died down a lot. We've had, riots. Those have died down recently. So, those kind of, headlines are starting to kind of pull off the market some. And again, markets have a way of pricing in expectation and pricing in things that are going on and adjusting for potential risks. That's what markets do. They try to look forward and they try to adjust for things before they happen. And so we're going through this correction right now, right? So we've had this 3-week correction going on now in stocks. It's been an orderly correction, nothing outside the norm. Back in August, we were writing in our newsletter about, hey, expect a 5 to 10% correction, completely normal. September, October would be the logical place of the year for this to happen. And it falls in line with what normally happens during presidential election years, right? You generally have a sell-off going into the market, going into the election, because markets don't know for sure who's going to get elected, right? And they kind of hedge their bets a bit. So it's not surprising to see this market selling off here a bit. And this is when we talked about, rotating into value stocks, raising a little bit more cash, adding to some fixed income, those type of things. And, those have been kind of the things to do here over the course of the last couple of months to lower volatility in portfolios. It doesn't mean you're going to protect 100% of the downside, right? It just means you're going to reduce the risk during the market declines. And that's the whole point of managing money. And so when we look at the statistics, though, of what happens during presidential election years and kind of regardless of, and this is regardless of who gets elected, right? Presidential election years are some of the strongest return years of markets historically. And the two strongest years are the year before the presidential election. So in this case, that would be 2019, which was a strong year. Markets were up 31.2% last year. And this year, the weakest of the 4 years of a presidential cycle is the first year of a new president. So next year. So 2021 tends to be one of the weaker years. That doesn't mean it's always weak. It just means on average, right? On average, it's one of the weaker years, usually up about 5.5% for the year. Now, the point about this is that when we take a look at markets, the first thing to remember is you don't get averages. So let's just throw that out the window right now, because we're talking about average return years. Last year, as an example, 31.2% upside was not an average year. The average year is about 11%, so way outside of norms. It also doesn't mean you can't have a negative year. Year before that, 2018, we were down 4.23%. The average year is 7.48 positive. So you can have disparities in returns. You don't get average, right? But normally, most of the time, since 1944, there have only been 2 down years during a presidential election, right? And that was 2000, 2008, when we were in the midst of a recession. We're in the midst of a recession today. So it certainly doesn't mean that we can't have a negative return year this year. But if we were going to have a negative return year in 2008 because of the recession, we would already be in negative territory to a large degree, and we're not. We just recently came off all-time highs. So there is, and of course, a lot of this has to do with, tremendous amounts of Federal Reserve, interventions. The Fed's still doing $120 billion a month in QE right now. So there's certainly a lot of things distorting the markets in the short term in terms of prices. And it certainly doesn't mean that, if we get into a contested election and if we don't get more stimulus for the markets and the Fed doesn't come to bear in terms of doing more QE, et cetera, could we have a sell-off into the end of the year? Absolutely. That risk is certainly there. But we have to look at historically how things work out, right? And, you're about to have a 30% plus bump in GDP for the third quarter. Now, this is important to understand. We were down 37% in the second quarter. We're going to be up 30% in the third quarter, right? So down 37 second quarter, up 30%. We're still not out of a recession. Okay, we'll still be in a recession, about negative 4 or 5%, which will still be one of the deepest recessions on record, even with that 30% jump. So fourth quarter will have to be, up another 10 or 20% just to get us back towards even for the year. And that's likely not going to happen. So we'll still be in a recession, which suggests that stocks should indeed be lower. And outside of normal, kind of the Federal Reserve interventions and everything else that's going on, if it was just kind of if the markets were left alone, very likely we would have a much lower stock market value right now than we do currently. But because of trillions of dollars worth of Federal Reserve intervention that continues, asset prices have been able to hold up and recover from the March sell-off very well. So if we go back, though, if we look at all of the election years back to 1833, okay, 35 of those election years. So out of a total of 46 elections so far, and we'll come up to the 47th, this month, going back, in November. But over all those election years, going back to 1833, 35 were positive, only 11 were negative. So you have basically a 76% win rate for election years. Now, don't discount the 24%, though, right? Roughly a 1 in 4 chance that this year could be negative. So, you can't entirely dismiss a 1 in 4 chance. But the odds, the statistics say that 3 out of 4 probability, and those are pretty good odds. I think most people would bet on a 3 to 4 outcome, suggests that this year will wind up on a positive return. Now, all that has to do is be up 0.000001%, right? That's a positive return. It doesn't have to be up a lot, it just has to be up barely. Now, normally we'll see what happens, but we'll see where we are. But again, this is just what statistics say, right? Next year is a different story. The first year of a presidential election is about 50-50, being up and down. Out of the 47 first years of presidents, going back to 1833, 26 were positive, 21 were negative. So it's about a 50-50 bet. Average returns about 5.6%. Some of your worst returns in history came in the first year of a new president. So again, just kind of keeping these things in perspective. And then the reason I'm telling you this is that, I'm getting lots of emails that, the world's about to end. We're going to have this massive, problem. If Joe Biden gets elected, all of his policies are going to kill the markets. And, and look, valid concerns, right? I got it. Historically speaking, again, just looking at markets versus statistics versus emotion. Statistics suggest that policy really doesn't matter that much to the markets. And I'll tell you why it doesn't. The reason is that what Biden is telling you on the campaign trail and what Trump is telling you on the campaign trail right now is very unlikely to happen. right? This is marketing, right? These guys are all out marketing. They want your vote. They're going to tell you whatever you want to hear to get you to vote for them. The other guy's bad. I'm good. Here's what I'm going to do if you elect me president. The reality is we know this. If we just look back over time, most of what they promise never comes to fruition. And this is particularly the case if you have political gridlock. In other words, you have a democratically controlled House and a Republican controlled Senate. Pretty much nothing gets done, right? And gridlock is good for the stock market. What the stock market doesn't want is big changes to tax policies, restrictive tariffs, these type of things. Markets don't like that. Markets want free flow of capital. And so if you have political gridlock and you have a situation to where not many things are actually going to change in terms of taxation and tariffs and these type of issues, stock markets tend to perform pretty well. So while policy is important, don't get me wrong, it just doesn't matter that much to the markets because markets tend to price that stuff in fairly quickly. And the knowns become knowns very rapidly. The thing that really trips up markets is the really unexpected, unknown exogenous event, like a pandemic, that nobody counted on. Be right back after the break.
Real Investment Show podcasts are now available on iTunes.
Listen anyplace, anytime
at iTunes.com.